Welcome back to the Market Podcast. Asymmetric info for individual investors. Educational info only, not financial or legal advice. Consult a pro before investing.
Imagine pouring millions into revolutionary AI drug discovery. You're watching cash reserves dwindle, yet the promise of life-changing treatments feels, well, just within reach.
It's a classic biotech scenario, really. High stakes.
Exactly. Is this aggressive spending a huge red flag, signaling maybe financial distress? Or is it the steep, necessary descent before a massive surge in growth, the kind that could redefine how you invest in biotech?
That's the billion-dollar question, isn't it?
Today, we're dissecting every layer of this puzzle, from the leadership's strategic gambles to breakthroughs in their drug pipeline.
We'll cover the tech, the financials, the whole picture.
And we'll land on a clear-eyed verdict. Our future capital raises, dilution, a necessary step before this stock could potentially skyrocket. And crucially, what does that mean for your portfolio?
To really get a handle on this company's journey, you absolutely have to start with the people steering the ship, the leadership.
And it's quite a lineup. Tell us about the key players shaping this company's future.
Well, leading the charge is Christopher Gibson, co-founder and CEO. He's a bioengineer, PhD from the University of Utah.
Okay.
And he's been absolutely instrumental in pushing the company towards this AI-centric drug discovery model. He led the IPO back in 2021, forged those really critical partnerships with giants like NVIDIA and Bayer.
Those partnerships sound significant.
They are. These moves built up the tech infrastructure they needed, especially important when you're burning cash at this rate. It's all part of sustaining that potential for massive growth.
Right. Who else is key?
Then you have Tina Larson, the Chief Operating Officer. She brings over 2 decades of biotech operations experience, including time at Jontech.
Jontech, that's a big name.
It is. And her expertise in scaling R&D has driven some serious efficiencies. She's helped optimize their operating system platform, cutting discovery costs and shrinking timelines. We're talking years down to months in some cases.
Years to months. That directly tackles the cash burn issue.
Precisely. And on the financial side, there's Michael Sikora. He's the CFO, also a co-founder, comes from Wall Street, Goldman Sachs background.
Finance expertise. Crucial.
Absolutely. His skills in capital allocation are vital for navigating the potential need for more funding, dilution risks as they balance that heavy investment against future growth.
Makes sense. Any other key influences?
Definitely worth mentioning, board member Zavain Dar. He's a venture capitalist from Lux Capital, brings a lot of AI investment savvy. His influence was felt in strategic moves like that 2025 Exscientia merger.
The merger aimed at cutting costs, right?
Exactly. Cutting costs and extending their financial runway. So what you see is this blend of tech and bio expertise shaping a strategy that, frankly, accepts early losses for potentially huge future payoffs.
And it seems significant that it remains founder-led. Gibson and Sikora are still right there in the thick of it.
Absolutely. Deeply embedded, from deciding which drugs to prioritize in the pipeline to integrating that big Exscientia deal, which, as we said, slashed their projected cash burn.
Gibson's original vision still drives things.
It does. It grew out of his academic work in cellular imaging. He continues to push for these, ambitious bets on AI to essentially decode biology. And their incentives seem aligned with investors. Lots of equity-heavy compensation.
So their fortunes are tied to the stock price.
Correct. It incentivizes focusing on that long-term growth curve, not just short-term gains. Though we should note, some recent at-the-market equity sales have slightly diluted that founder ownership. It's something to watch if the burn continues without major milestones.
And their mission is crystal clear. Decode biology to radically improve lives, aiming for a 90% cut in drug failure rates using AI. That goal really frames this whole story, doesn't it?
It absolutely does. That goal underpins the whole narrative. Today's spending is positioned as the seed funding for tomorrow's cures.
They talk about TechBio dominance.
Right. Gibson even described their operating system as a Google Maps for biology. The idea is designing drugs with precision, even for diseases currently considered untreatable.
And the company culture reflects this.
Yes, it emphasizes industrialized drug discovery. Values like boldness, collaboration. They encourage rapid iteration through things like hackathons and data-sharing norms. It's designed for speed.
Which could accelerate that growth curve.
Potentially, yes. Although the 2025 layoffs aimed at curbing spending are a real test of whether that strong alignment holds up when things get tight.
So let's break it down for individual investors. How does this company actually make money? What's the core business?
Well, think of it simply. It's kind of like using a specialized search engine for biology. You feed a huge amounts of cell image data, the AI spots disease patterns, and it spits out potential drug candidates much faster than old-school labs.
Okay, faster is key. But how does it work technically?
The secret sauce is their operating system. It integrates different kinds of data phenomics, which is that detailed cell imagery, transcriptomics, tracking gene activity with sophisticated machine learning. It maps biological relationships.
Mapping biology.
Yeah, picture a complex video game engine. Cells are characters, AI runs what-if simulations to predict if a drug might work. It cuts down massively on trial and error.
But the proof is in the pudding, right? Clinical trials.
Absolutely critical. The success hinges on validating these AI predictions in actual human trials. Failures there would definitely amplify concerns about the cash burn.
What about their main products or services right now?
The flagship is the AI platform itself, their operating system for drug discovery, and it has found product market fit. Look at the partnership revenue, $132 million in Q1 2025.
That's substantial, but mostly upfront fees.
Correct. Not ongoing royalties yet. That comes later with drug approvals. Their pipeline has clinical stage candidates like REC-3565 for B-cell lymphomas that started phase 1 dosing in 2025, and REC-1245 for solid tumors. Shows their focus on oncology and rare diseases.
And the roadmap.
They aim to advance over 10 programs by 2027. Plus, they recently acquired full rights to REV-102 in July 2025. That's a potential first-in-class oral therapy for hypophosphatasia.
How does acquiring a drug like REV-102 help?
It adds a potential near-term revenue stream through milestones, which could help offset the burn. And crucially, those big pharma partnerships provide non-dilutive funding. That cushions the dip in the J-curve. It's key to managing this investment phase without constantly issuing new stock.
In such a crowded biotech field, what really sets them apart?
It's their full-stack AI model. It uniquely combines deep biological expertise. They're really good at generating and mapping data-rich biology with an economic engine fueled by those partnership revenues and this genuine passion for curing rare diseases.
So it's the integration.
Exactly. Their model uses arguably the world's largest relatable dataset phenomics plus chemistry to predict potential drugs maybe 10 times faster than competitors.
Any examples of that speed?
The Bayer collaboration is a good one. They identified novel oncology targets in months, not the usual years. It shows how this unique approach could ignite that growth curve, if they can scale it effectively. Of course, maintaining that edge requires continuous investment, hence the current burn rate.
Let's talk history and operations. Give us the timeline.
Founded in 2013. The 2021 IPO was pivotal, raising $463 million, really essential for building out the platform. Then the 2025 Exscientia merger extended their cash runway out to late 2027.
They've adapted, haven't they?
Yes, shown real agility, like focusing more on high-value oncology after the merger. Revenue grew 32% year over year to nearly $60 million in 2024. But losses also widened negative $87 million quarterly. That clearly shows this intense investment phase. They have a niche, but definitely growing share in AI drug discovery.
And where do they actually do the work?
Headquarters are in Salt Lake City, Utah. That's where the labs with robotics and AI are. They also have sites in Montreal from the Exscientia deal, that's computational biology, and London for European partnerships.
Do they own all these facilities?
Mostly lease them, actually. It minimizes capital expenditure. And they outsource non-core things like manufacturing to contract research organizations, or CROs. It gives them flexibility, but also means they depend on external partners, which is a factor in managing cash during these early stages.
How vertically integrated are they, and how do discoveries reach the market?
I'd say moderately vertically integrated. They control the core data generation, the robotics labs, the AI software, but clinical trials and manufacturing, that's outsourced.
What's the benefit of that approach?
It lets them control the crucial discovery part, and they claim it cuts costs by 50% versus traditional methods by finding drug candidates faster. A real cost edge. But not having full control downstream could potentially slow things down if partners stumble.
And distribution, getting drugs to patients.
That's purely B2B, business to business. Through partnerships with Big Pharma Roche, Sanofi, for example, they license their discoveries for upfront fees and milestone payments later on.
Is that model innovative?
Yes, because it leverages their AI datasets digitally. It's very scalable. And it's proven effective for bringing in non-dilutive funding to weather the cash burn. Generated $83 million pro forma in 2024 revenue just from these joint ventures.
How predictable is that revenue for you, the investor?
It's quite variable right now. Maybe 70% comes from one-time partnership fees, like that big $132 million in Q1 2025. Milestone payments add unpredictability too.
Which impacts stability.
It does, especially when your annual burn is around $450 million. Long-term deals like the NVIDIA one provide some recurrence, but until drugs are approved and royalties start flowing consistently, this variability increases the chance they might need to raise more capital. It heightens that dilution risk during these critical early growth stages.
Okay, let's pivot to their competitive advantages, their moat. How do they protect their innovations and sustain themselves through this high cash burn? Again, estimated at $450 million or less for 2025.
Right, and remember the context. Traditional drug development costs over $1 billion, takes a decade plus, and 90% fail. Their AI platform aims to shatter that model.
But the burn is real. What about dilution?
The runway extension to mid-2027, thanks to the Exscientia merger synergies and pipeline focus, is positive. But the probability of needing more capital dilution before a potential stock surge is still high. I'd estimate around 75%, especially if key clinical results like that REC 4881 phase 2 data due in H1 2026 get delayed.
Do they have anything like a monopoly?
In their specific niche AI-driven phenomics discovery, they have something close. That proprietary dataset, over 25 petabytes. It's the world's largest relatable biological dataset.
I mean, that's hard to copy.
Incredibly. Replicating it would cost billions and take years. It's a massive barrier to entry for startups. Plus, the whole AI drug discovery market is exploding, projected $50 billion by 2030. They're capturing maybe 5–7% now through things like FDA fast tracks for RDC 4881.
Regulatory advantages help too.
Yes. Orphan drug designations for rare disease programs, like the newly acquired REV102, grant 7–10 years of market exclusivity after approval. These things help generate non-dilutive revenue, like that $7 million Sanofi milestone in Q1, mitigating the burn concerns.
How do economies of scale factor in?
Hugely. The fixed costs of building their OS, the robotics, the NVIDIA supercomputing, mean the cost per drug candidate plummets as they generate more data. Industry average per experiment might be $10K, $50K. They claim under $1,000.
Because it's automated.
Right. Automated screening processes millions of assays weekly. That yield 50–70% cost efficiencies. It lets them pursue more programs now streamlined to 5+ while managing the burn better. That significant Q1 R&D spend, $130 million, is really an investment in this scale advantage.
You mentioned network effects earlier. How do those work here?
Their platform definitely benefits from network effects. Each new pharma partnership adds data, which makes the AI smarter, which attracts more partners. It's a self-reinforcing loop.
Like the Bayer deal.
Exactly. That deal integrated specialized oncology data, boosted prediction accuracy 2–3x, and brought in $132 million upfront, directly offsetting the burn. With partnerships doubling since 2023, think Roche Genentech potential at $12 billion, recent Sanofi milestones, the value grows exponentially with users. This flywheel helps justify that aggressive burn for data accumulation now, hoping for recurring revenues later that reduce reliance on dilution.
What about their unique positioning in the market?
They position themselves as a full-stack TechBio integrator. They blend AI with their own wet lab biology to go after targets others can't, the undruggable ones.
An example.
REC 1245 getting investigational new drug clearance. It targets RBM39 degradation in solid tumors. Potential first-in-class where traditional chemistry struggled. And NVIDIA's investment in their low-dimensional models provides market validation. Partners like Roche praise it for cutting timelines. This unique position frames the burn as necessary investment to maintain that edge.
Let's run through other advantages: switching costs, branding, resources, processes, tech, timing, speed, sustainability, and potential threats.
Okay, quickly. High switching costs, lock-in partners, migrating custom maps, and AI integrations cost millions, disrupt pipelines. Think multi-year Roche deals. Brand-wise, they're emerging as a trusted AI pioneer, helped by the NVIDIA Alliance and media buzz calling them pharma's future. Cornered resources, over 100 patents on AI biointerfaces, top talent lured by equity, exclusive NVIDIA supercomputing access.
Processes and tech.
Proprietary processes honed since 2013 give a claimed 90% quality edge. The OS offers 10x efficiency, simulating billions of interactions. Timing. Perfect alignment with the 2023-2025 AI boom, securing first-mover status in TechBio. Speed. Shown by the rapid Exscientia integration and REV102 acquisition.
Are these advantages sustainable? Any risks?
The data and patent moats look sustainable for 10–15 years. Biotech regulation slows things down, but potential erosion could come from open source AI, like AlphaFold getting better, or maybe quantum computing entrance down the line. Staying ahead means reinvestment, possibly needing more capital.
Okay, let's talk growth and resilience. How does this tie back to whether the 2025 burn erodes value through dilutions or fuels that J-curve?
Well, biotech resilience often hangs on having a diverse pipeline and being aligned with major trends. Streamlining the pipeline in Q1, focusing on oncology rare diseases, improves efficiency, sure, but it also concentrates risk if those remaining drugs fail.
So dilution risk remains high.
That 75% probability pre-2027 still holds. The runway to mid-2027 assumes things go reasonably well, but hit a major milestone, like strong phase 2 data for REC 4881, and that could absolutely trigger the J-curve upswing. It reframes the burn from a cost to a high ROI investment.
What's their explicit growth strategy?
It's about penetrating existing markets with platform licensing, like the Sanofi deal, expanding geographically, hence the London site for Europe, and innovating products like enhancing their models for fibrosis. But the actual drivers are clinical progress in those 5+ programs and M&A like Exscientia and REV 102. Mechanisms like data-driven reprioritization help cut costs 20–30%. That tempers the burn, focusing resources to support that J-curve.
What are the big opportunities and risks?
Opportunities. Entering the agent market may be a $30 billion TAM, though there are IP risks. New launches like REC 1245 starting phase 12 trials in late 2025. The Bayer deal shows the potential reward $1.5 billion upside. But the risk, that 90% historical failure rate could prolong the burn and force solutions.
You mentioned the total addressable market, the TAM. How big is it?
It's huge. Over $100 billion now. Growing 15–20% annually, potentially hitting $200 billion by 2030. Key segments are oncology, rare diseases, fibrosis. Their AI aims to capture 5–10% of that. That potential justifies the burn needed for expansion.
And the technology applies broadly.
Very broadly. Across pharma, from oncology to academia, scalability comes from digital licensing. It builds market resilience.
How robust are their supply chains and customer base? How long can they last?
Supply chain seems diversified, global CROs, tech partners like NVIDIA with backups that helps mitigate risks in downturns. Customer base is also diverse, 70% big pharma like Roche, plus tech and academia globally. Long-term contracts add stability against the burn volatility.
And long-term need for what they do.
There's likely an 80% probability of enduring need, driven by secular trends, AI, and healthcare aging populations. Expect 20% market adoption by 2030. They seem resilient to downturns because of efficiencies, but a deep recession without cash inflows could still force dilutions.
So boiling it down, key growth drivers versus main risks.
Key drivers. Hitting milestones like that, promising REC 4881 data, partnership success delivering synergies, and faster, better AI iterations. Main risks. Big pharma building strong in-house AI, market saturation eventually, and regulatory delays stretching out that cash burn phase.
Let's bring in the wider economy. How do macroeconomic factors intensify the focus on their cash burn?
Well, 2025's inflation and higher interest rates can squeeze margins. That could force dilutions if efficiencies don't fully compensate. And biotech funding overall dipped 20% industry-wide recently, so these factors really test the viability of that J-curve.
How do interest rates and trade issues play in?
Higher rates make borrowing more expensive, though they have little debt now, maybe $50 million. It pushes funding towards equity, meaning dilution. Trade tensions, especially with China, can disrupt supplies for things like chips and lab equipment, inflating costs, potentially delaying trials. And general R&D inflation, maybe 10–15%, compresses margins. It could even curb demand for AI partnerships unless those efficiency gains really shine through.
Any company-specific macro factors?
Yes. The slowdown in venture capital funding affects the whole sector. And things like the Inflation Reduction Act, with its potential drug pricing caps, could limit future revenues. That extends the burn phase and maybe pushes dilution odds closer to 80% if drug approvals get delayed.
Let's get concrete. Give us the financial picture as of mid-2025.
Okay, Q1 2025 financials really paint the picture of a biotech deep in investment mode. A $202.5 million loss on $15 million revenue. That screams J-curve bottom.
But there's a positive spin.
Yes, the runway extending to mid-2027, thanks to those $100 million in synergies, suggests a potential inflection point ahead. The snapshot says, big bets on AI, future capital raises likely a bridge to get there.
Key metrics walkthrough.
Sure. Q1 revenue, $15 million, up about 7% year-over-year from partnerships modest, but shows demand. Profit margin, deeply negative, negative 350%, reflecting that $202.5 million loss from R&D and admin costs post-merger. Typical for this pre-J-curve phase. Rule of 40 is 90–25% growth focus, not profit yet, standard for TechBio. ROIC is negative, with $577 million, historically invested in the platform, but targeting 15–20% post-milestones.
Cash and debt.
Around $500 million cash equivalents. Low debt to equity at 0.1, strong current ratio near 4x, but a $42.6 million dilution was noted. Book value growth is flat due to losses and dilutions. Free cash flow negative, around -$200. Those synergies should improve this.
Key specifics.
5 phase 3 programs, runway to mid-2027. Projected burn equals $450 million for 2025.
How does this compare to peers like Tempus?
Their growth rate is actually better than median 25%, but the burn is higher, $450 versus Tempus's $300 rounded average.
Yeah.
Margins are weaker. Their strength is that cash buffer.
And the trend over recent years?
Past 3 years show revenue growing plus 30%, but losses also increasing plus 25% year over year. It implies interim dilution is likely, but maybe a path to profitability by 2028, with revenue estimates around $188 than that.
What about recent news and the general conversation around the company?
Okay, recent events. In July 2025, they acquired full rights to REV-102. That adds first-in-class potential, extends the runway, big positive. Back in Q1, they streamlined the pipeline, deprioritizing some programs to focus efforts. Also good for burn control.
What's coming up that investors should watch?
Q2 earnings in August, and the really big one, Phase 2 data for REC-4881 in the first half of 2026. For individual investors, keep an eye on any at-the-market dilutions and presentations at major medical conferences for signs of J-curve progress.
And the buzz online, social media.
It's mixed right now. Looking at places like X, maybe 60% of the talk is cautious about the burn and dilution risk. But there was definite positive reaction to the REV-102 acquisition comments like cash runway extended into 2027, leaner focus.
But concerns remain.
Oh, yes. You see things like dilution kills momentum. A lot of focus on needing strong execution and positive trial results. The dominant narrative is optimism about the AI upside if they hit milestones, mixed with frustration if the burn just continues without big wins.
All right, valuation. This feels like the crucial piece for understanding their journey.
Yeah.
How does it frame the burn versus growth question?
Valuation is absolutely the linchpin here. It helps quantify whether that ongoing cash burn may be $450 million for the year.
Yeah.
After using $118 million operationally in Q1, puts investors on a path to painful dilution or onto the rewarding upswing of that J-curve.
Especially in biotech where outcomes are so uncertain.
Exactly. Valuations swing wildly. One good trial can send the stock soaring 5–10x. A bad one can cut it in half. It makes that $120 million quarterly cash burn feel much more acute. Right now, their market cap is around $1.4 billion. That's way less than peers like Tempus AI at $5 billion. It shows market skepticism about their pre-profit stage, but also hints at potential undervaluation if that AI platform really delivers on slashing drug development costs and timelines.
How does the sector valuation play in?
The wider TechBio sector trades at high multiples, maybe 15–20x price to sales for AI firms. But with negative earnings, traditional metrics are tough here. That increases that 75% dilution risk pre-2027, especially if the valuation doesn't start reflecting progress, like the REV-102 deal or upcoming REC-4881 data.
What's the current stock price telling us? Around $5.89 as of July 19th.
Yes, about $5.89. A tiny gain recently, but still down about 27% year-to-date. That reflects sector volatility and those burn concerns. At this price, it's trading at a forward price to sales of roughly 35x, based on 2025 revenue estimates of $40–50 million.
85x sounds high.
It's a premium to the average biotech, yes. But bulls would argue it's justified by growth potential from partnerships like Sanofi and Roche, which could unlock $100 million plus in milestones.
What about a margin of safety for you, the individual investor?
Margin of safety means buying at a discount to intrinsic value, giving you a buffer against estimation errors, market dips, bad trial results. For this company, burning $118 million cash quarterly, with runway only to mid-2027, a strong margin of safety, maybe 30–50% discount, is really crucial.
To weather potential dilution.
Exactly. New shares issued could dilute your ownership by 10–20% each time. Without a good entry point, that burn phase is tough. Although the current price being below analyst targets does offer some cushion.
Why is valuation so critical for this specific company?
Because it's your compass in the fog of uncertainty, especially for a loss-making biotech. Is the stock overpriced, risking correction due to burn fears? Or undervalued, signaling a chance to get in before J-curve upside? For you, it clarifies risk versus reward. If intrinsic value based on hitting milestones is maybe $10, buying at $5.89 offers 70% potential upside. That helps offset dilution risk. History shows valuation matters. Poor valuations sink biotechs. Good ones like Moderna pre-COVID delivered huge returns. Here, overvaluation makes the burn look scarier. Undervaluation supports the AI transformation story.
Which valuation methods work best here, given the AI and pre-revenue status?
You need a mix. Traditional PE is useless with losses projected at $1.34 share for 2025. Intrinsic value using discounted cash flow, DCF, is key. You project future cash flows, discount them back heavily, maybe 12–15% WACC for biotech risk. Analysts get 7 and 12 fair value this way, assuming $188 million revenue by 2028, and maybe 20% success on those 5+ pipeline drugs like REC 4881.
What about relative valuation?
Comparing price to sales is useful. There are 35x versus 10x for average biotech, or 15–20x for AI peers like Tempus. Shows a premium for the tech, but maybe a discount to pure growth plays.
And sum of parts.
That's particularly good here. Value the platform, the 25 petabytes data, maybe $2–3 billion. Value the partnership's potential milestones, $1–2 billion. Value the pipeline risk-adjusted NPV for the drugs, maybe $4–6 billion. Add it up, you get around $8–11 per share. A hybrid of DCF and sum of parts probably captures it best.
Okay, let's lay out the competing investment cases. The bear versus the bull.
Right, the bear case, steel manning it. The path is full of pitfalls. Biotech is capital intensive. 90% of trials fail historically. That $450 million 2025 burn looks unsustainable without constant dilutions eroding shareholder value. Look at the recent raises adding 10–15% to shares. Bears worry about over-reliance on unproven AI, competition from big pharma's own tools, and macro squeezes like IRA pricing caps. Retail echoes this. Dilution kills momentum. I'd put maybe a 45% probability on this cautious view.
Now the bull case.
The bull case. They're primed for a J-curve explosion. The AI platform, backed by NVIDIA's $50 million in supercomputing, is industrializing drug discovery, targeting a huge $100–200 billion TAM with 10x efficiency, aiming for 5–10% market share by 2030. Analyst buy ratings, $7 average price target, point to $100 million plus merger synergies and pipeline catalysts like REC 4881's promising early data and the REV 102.
And retail sentiment
Amplifies this, calls it a multi-bagger, citing the AI native advantage, visionary leadership, the NVIDIA deal as a golden handshake. Upsides are non-dilutive milestones offsetting burn, favorable AI healthcare trends, better execution post-layoffs. This optimistic view, like Moderna before validation, maybe has a 55% probability.
So the most probable thesis.
Leaning slightly bullish, I'd say. Given AI momentum, the extended runway, and catalysts that seem undervalued right now, the near-term burn risks seem outweighed, especially in a recovering biotech market. At $5.89, the stock looks like it trades at a 16–20% discount to that $7 analyst consensus. It suggests the market is overly focused on burn, underpricing pipeline potential, and synergies. Offers a margin of safety for J-curve believers.
Let's tie it all together then, answering the big question. Is this cash burn a red flag or a stepping stone to massive growth?
Individual investors should definitely pay close attention to the burn. $450 million projected for 2025, $118 million operational outflow in Q1, $202.5 million net loss. It underlines the high-stakes game of biotech R&D. Upfront investment dwarfs current revenue, just $15 million in Q1, mostly partnership fees. Without fresh capital, that $500 million cash pile could run out by mid-2027.
So attention is warranted, but is it just the early stage?
It strongly appears to be the early high investment phase of a potential massive growth curve. I put a 60% probability on that. Today's losses fund tomorrow's exponential growth, similar to Moderna before their vaccine breakthrough. They're using AI to de-risk discovery. Look at the early RVC 4881 data, the REV 102 acquisition, the potential blockbusters in a $100 billion market.
And the why behind this potential payoff?
Several factors. Merger synergies, $100 million expected, mostly in 2025. Efficiencies like the workforce cut extended the runway.
Yeah.
NVIDIA's tech boosts platform accuracy, all positioning them for milestone payments like the $7 million from Sanofi and hopefully drug approvals by 2027–28.
But dilution risk remains.
Yes. Even if the J-curve plays out, there's still that 75% probability of future capital raises before the stock really takes off. Dilution means issuing new shares, maybe via at-the-market offerings, adding 10–20% to the float. Your 1% stake becomes 0.80–0.9%. Often happens at lower prices, temporarily hurts the stock. But it's how companies like this survive and grow. Look at their $42.6 million raise in 2024.
Why is the probability still so high?
Persistent losses estimated $1.34 per share for 2025. But they can mitigate the impact by timing raises after good news, like positive phase 2 data. Minimize the pain before potential 5–10x upside from royalties later. My take. This burn level is biotech's entry fee. It seems justified by their competitive advantages, that massive data set and strong trends like AI adoption in healthcare, 20% by 2030. It tips towards J-curve success if execution stays sharp.
Finally, a last thought for our listeners to consider beyond today's discussion.
Okay. Thinking from first principles.
AI fundamentally compresses biological complexity. That creates asymmetric upside. One big hit, like an oncology blockbuster, can genuinely pay for years of burn. So as an investor, maybe focus more on the scale of their data moat than just the short-term losses. That could be an edge. But always be aware of the key risks. Trial failures happen 90% of the time historically. That could force unplanned dilutions, 80% odds if milestones slip. Key uncertainties: regulators changing rules for AI validation or unforeseen IP challenges. For more insight, watch social media sentiment after news drops. Maybe consider timing entries after dilution announcements to avoid the initial dip.
Love this? Drop a like, subscribe, and ring the bell so you never miss a podcast.